Very good afternoon, everybody. Welcome again to another session of Friday Drinks on a very cloudy afternoon in Harare. It's been a hectic week, but lots to celebrate and lots to look forward to, especially if you're a farmer. We've had good rains in January. I don't know if that will somewhat help the season in general. What are your thoughts, Ranga? You're the farmer.
Yeah, it's been a good January so far. Even the crop, I mean, even for some farmers that had their crop affected by the dry, is it November, December, thereabout?
Yeah, December was dry.
A number of them have had to replant. And this January has been very good to them. The crop is looking very good. So it's not just good for us farmers, but even for the likes of Rofaro as well. I mean, it has got an impact on even the businesses.
A knock-on effect. Yeah. Absolutely.
A big one.
I suppose by end of February, or we should know what the crop will look like, what we've actually produced.
But it's certainly likely to be a much better year than last year.
Okay. Answered a number of questions with the latest numbers and latest data. Maybe you can just give us highlights of what the central bank has been saying and what the latest numbers that we have, and then we'll get into the details. I think what we want to talk about is just, where the market situation is, with the banks, with RBZ, market liquidity, and then Treasury, and then sort of anticipate what the monetary policy will look like in February. That's really to support the not midterm, but the end of year budget that was actually presented in November.
No, thank you so much. I'll just speak to some statistics that I believe maybe would help us as we analyze the situation. So one number that is of interest is the reserve money, which central bank is saying have managed to maintain at 5 billion ZiG. Since September. So that number has been hovering around 5 billion ZiG. And then total deposits in ZiG deposits, that is, in the market is about 12 billion. And they've been around 12 billion, plus or minus 12 billion since September again. So it looks like the September
So date, after the devaluation?
Yes, the September date is where the stability started to really come from. And the view on the liquidity crunch, obviously in the marketplace, we see it, we feel it. But the views from central bank is there's no liquidity crunch, because on a daily basis, the market is long 1.3 billion to 1.5 billion. And this has been the case since September. And to a point that RBZ have had to use non-negotiable certificate of deposits to sterilize that long position. But obviously, what needs to be said is this long position is not like evenly sort of distributed. So there are certainly banks that are short, but it speaks to maybe the reality that the interbank market is not active, so banks are probably not lending to each other.
They're not trading with one another, but central bank as the bank of last resort, surely they should be able to accommodate the banks that are short.
No. So the attitude of central bank, I mean, I think even banking...
When you say no, what do you mean?
Because the market is long. So before you go to the central bank for accommodation, you need to be accommodated within the market. So as long as there's that 1.3, 1.5 billion surplus on a daily basis, the expectation is the bankers must be able to trade amongst themselves. Only when they've depleted and the position in the market cannot then cover the need, you then go to the lender of last resort.
Well, there are obviously a number of problems.
Maybe let me finish and then you can.
No, we wanted to just discuss that, then we discuss the other points.
All right, that's fine.
Otherwise, we'll forget. But because you had the connection to actually talk to central bank, so we're gonna fire away questions at you, the questions that you should have asked them, But anyway, let's get into the details. So let's get into the words. So what I mean is, number one, for you to get credit from another bank, you need security. And typically the security that should be on offer are TBs, and everybody has got TBs in the market.
Yes.
So the TBs are there. But the problem is no one is trading TBs anymore because they know that that paper is not worth the number that it's written on.
Is it what you're saying about the paper?
Yeah, because they didn't settle about 177 million worth of TBs end of last year. The central bank didn't settle that. So if you're a bank, let's say I'm a bank and I'm up ZIG or US dollars, and there's a bank that's down, and then the bank says, okay, can we please have some of your liquidity, and as security I'm giving you TBs. And I'm like, I'm already awash with TBs.
So the central
Why
bank
should I pick up those TBs?
Just a point of correction there, just a quick one. The central bank doesn't issue TBs and it doesn't settle TBs. It's Treasury.
Did you get the point? The point is there's a bank that's up and there's a bank that's
No, I hear your point. You're saying but you said the central bank hasn't been settling TBs. I'm saying it's not the central bank that settles TBs.
Yeah.
It's Treasury. It's Treasury.
Okay, yeah.
That's just a point of correction.
Okay, fair enough. It's Treasury, but Treasury hasn't settled TBs.
Yeah.
So why, if I'm awash with TBs, why should I pick your security? Because I don't need it. Because in the event that you default on the cash that I've given you, I should be able to take the TBs to central bank or to Treasury.
Yeah,
that's the whole idea of security. But if that security is useless,
you still need the TBs on your balance sheet.
I already have.
I actually don't think it's useless because TB is, government security is the only paper that you can have on your balance sheet at 1-to-1 in terms of the IFRS 9.
That's theory.
No. For purposes of reporting, you can have it as 1-to-1, and it cannot be. I mean, you think your auditors can discount that?
No, I'm saying, but the reality in the marketplace, if you give me the TBs as security, so you want liquidity, you don't have liquidity, I've got liquidity. So I exchange my liquidity for these TBs.
Yeah.
Right? And I exchange with short-dated TBs. And then you fail to settle, to give me back my money. I should be able to take the TBs to the central bank or to government and say, you know what, Ranga gave me this as security, but unfortunately he is unable to pay me back, and he gave me this security. Now I'm taking it to you. You should be able to settle. Now, if government cannot settle, it means that the TBs are useless for me and my liquidity. So I'm better off always keeping my liquid position. Because there's no
and for
other...
that you get NNCDs. Do you think is a smart play as a banker? So you are getting now a zero-rated paper,
which is not negotiable. So you can't discount it, you can't trade it. It's just
it just sits on your balance sheet.
I actually think so.
It doesn't contribute to your liquidity.
I think from a risk management perspective, I actually think so, because at least on my balance sheet.
How is it better than the TB? That at least is promising.
Because the minute you fail to settle, the minute you default, I must write off that investment. The minute you fail to settle. So I'm better off with my balance sheet where I have 0% and it's with the central bank than Ranga failing to settle. Because if Ranga fails to settle, I must write it off or I must fully provide for it. Now, it's a double whammy because I must fully provide for what you defaulted on, plus the Treasury that has also defaulted on its Treasury bills. So I'm like, you know what? Yes, I'm worse off, but I'm better off with the central bank that's taking my money at 0%.
So, Tinashe, I hear what you're saying, and I'm just going to be a devil's advocate from a free market standpoint. If a bank that's long would rather have an NCD than advance some of that liquidity to a bank that's short, it's a free market. It's a choice that they're making of their based on their assessment and their disposition in terms of what they're more comfortable with. What's wrong with that?
Well, a number of factors. Because remember, the issue is the market must be liquid. There must be an efficient market. There must be trading. Where Ranga is coming from is, if Treasury was settling TBs, then I would happily lend my money to anyone in the market who has TBs. Because then I can eventually go to Treasury with those TBs and they'll be settled. So these are the asymmetries in the market. So there are serious asymmetries in the market that somebody who's very long is extremely long. And what they're managing is just purely risk management. I'm better off with zero that I don't write off than with Ranga, who then eventually defaults. Not to say that what the central bank is doing is right, I'm not saying that, but I'm just looking at it from the bank's position that is up, that has the Zim dollars. And if you look at where the Zim dollars are actually coming from, the Zim dollars are actually coming from exporters, right? That 25% exporter surrender.
The retention.
The retention. So the bank that is up knows that almost every month this money is coming back to me. Now, am I better off lending this money to Ranga, whom I know will default, or waiting for the central bank to take it as zero? Because that money was always going to be in my bank.
But
anyway,
the difference
zero.
is this Ranga is also another bank. So I don't think it's entirely look, it's good for banks to be skeptical. They've got their own ways of assessing risk of fellow colleagues. But this is and I think banks probably have got other ways of ensuring that they are compensated for the increased risk that they are taking, whether in terms of asking for a higher interest rate and etc. I don't think it will be good. It's good banking for a treasurer to just sit on the liquidity simply because they are trying to avoid the risk. That is caused by maybe lending to another bank.
The treasurer is being hamstrung by the risk manager. The risk manager can clearly see that the market, there's flight to quality. Because what should actually happen is the customer at the end of the day who's bringing in the deposit, if they believed in Ranga Bank PLC, they would have just divided, right? Because you're going to that same customer and offering a higher interest rate. And what's good about that customer is they don't require security. They just need a banking license. But that customer is saying, Ranga, I don't trust Ranga. I trust this other guy. I trust Rufaro PLC. Right? I trust. So the efficient market should work this way. So the customer doesn't trust Ranga, but they trust Rufaro, which is fine. Now, Rufaro Ranga is now going to Rufaro and saying, hey, can you please give me some of that liquidity? Rufaro says, no, I don't have a problem at all. Just give me the security, the appropriate security. And then you say you have TBs. And he says, my TB government defaulted 177 million worth of TBs. Yeah. Those TBs are useless to me.
Wow.
So I'm better off. Rufaro is saying
those are very strong words for government paper. But anyway, that's the situation that they find themselves in. I don't know if banks are really taking that line of thinking, but what you are seeing on the ground is increasingly that surplus position is recurring. And
with certain banks.
Yeah, with certain banks. And the central bank is hitting them with these NNCDs. And the bank, they seem to be okay. So
Rufaro, I want you to come here. Do you think that there's a flight to quality, or there isn't? Just as a market analyst, if you're just looking at it and you're seeing that 80% of the deposits are in 20% of the banks.
So I don't know. There is no flight because that's been the status quo for the longest time.
Okay. So why is that?
Deposits have always tended to be skewed in favor of certain institutions. So that's just the nature of. And I don't even think it's a Zimbabwean phenomenon. I think it's if you go to any jurisdiction anywhere in the world and you analyze deposits, they're not equally distributed across institutions.
So why are certain banks? So anywhere else in the world. So let's not start with Zim. Let's go to South Africa or the US. Everywhere else in the world, when deposits are, there's always flight to quality, but deposits are stuck in particular banks. How do you ensure that these deposits are also then spread to other banks? What is the market mechanism that ensures that those deposits eventually end up with other smaller banks?
Well, look, I don't think that there's a market mechanism that does that. So if you actually look at the US, we saw some of the regional banks fail last year, like Silicon Valley Bank, right? There was
because there was a default.
Not just that. I think because we live in the 21st century. So, fun fact, I don't know how many years ago.
Is this your way of running away from the question?
I'm not running away from the question. I'm answering the question. So if you go back half a century, right? If there was some if a bank received some bad press, and some depositors got nervous and wanted to take their money out, they would literally have to queue outside the branch and then see a teller and either have notes counted out to them or fill out forms to wire the money to someplace else. And the bank that is managing this, crisis could actually instruct all its employees at its branches to slow down transactions, so that it takes longer for a transaction to happen while they engage the market in terms of, from a public relations standpoint, and perhaps change the narrative out there and get away from, the challenges that they're facing. But fast forward to where we are today, right? If there's a narrative out there that an institution is in trouble, which is what happened to Silicon Valley Bank, they got a couple of things wrong. The word got out, and all it is just people logging onto their mobile devices and wiring money. So overnight, you can literally have 90% of your customers moving their money out of your institution, which was impossible half a century. So even if the management team at that bank had a plan, within 24, 48 hours, it's too late. The deposits have exited and the bank is technically insolvent, which is what happened to Silicon Valley Bank. So, and a couple of other regional banks in the US went through the same challenge. So they're not all the same, right? There's the big 4 or 5 banks in the US that are deemed by the regulator to be too big to fail. And everybody knows that whatever happens, their money in that institution is safe. And then all the other smaller regional banks, well, they can fail, So, and I think that Zim obviously has got a different regulatory framework, but the same. I think in the customer's imagination, some banks are regionally owned, they're bigger, they're safer than other banks. And so you will see that skew in deposits. 80% of deposits are in 20% of the institutions.
Okay, Ranga, let's go back to banking 101. Mm-hmm. You have retail banking, you have wholesale banking, you have discount houses, you have a whole litany of market mechanism that ensures that whoever wants liquidity, before the central bank comes in, they'll be able to get liquidity. Do you agree or disagree with that statement?
Yeah.
You agree with that statement,
yeah,
right?
That's typically how the financial system
would work. Yeah, if you're a discount house, you would discount the TVs. If they're BAs, so unfortunately in Zimbabwe, nobody trusts the BA market anymore. And again, I put it back to the central bank because certain BAs just don't perform. So nobody trusts the
bankers'
acceptances. Mm-hmm. So the only thing that people trust is treasury bills. Well, up until last year, because at least when you had a treasury bill, there was some semblance that central bank or treasury will settle it at the end of the day. So I was happy to give you in the wholesale market. So maybe not in the retail market. I wouldn't be able to pick up the deposit in the retail market, but I'll be able to pick up the deposit in the wholesale market. And the wholesale market relied on an underlying security for me to give you that deposit. Now, if the underlying security is not performing, it makes it very difficult for me to then give you. So it's not the treasurer. The treasurer would love to make money. But the problem is the risk management guy is saying, well, what type of security are they giving you? And then the treasurer says, he's giving me TBs. How long? It's 90-day TBs. So he says, oh, okay, that's great. It's 90-day TBs. But the problem is the last 90 days, government didn't settle. So yes, you're going to get those TBs. If that guy defaults, you're going to have TBs that will be rolled over, and Treasury has come out and they've said the short-dated TBs, they're going to roll them over, but it's going to be longer term. So if you're a risk manager in a bank, you're saying, I'm actually better off keeping my deposit, let the central bank take it, with an NNCD, unless they start making the NNCDs longer term. But with an NNCD, at least nothing happens as far as my balance sheet is concerned. My big problem is if I give Ranga this liquidity and he defaults, I have to write it off. And that's a bigger problem that the banks are. So look,
indeed, there's a confidence problem in the market. in fact, not just the market, the whole economy. I didn't realize that maybe that was it was that bad, or maybe Tinashe is trying to paint this very gloomy pictures. But certainly, I agree with you that to a large extent the TBs have really not performed as much as you'd expect. Because if you find yourself in a situation where a paper is rolled over, or you are sort of forced to roll over, that's a technical default in a way, and it's even worse if it's rolled over and then the tenure is increased. So if that is the picture that is there, then it just explains why the financial sector,
there's a gridlock.
Yeah, there's a gridlock.
That's really what I'm saying, because
someone is happy to. Because ordinarily, yes, it should work like that. That you are funded from your retail deposits. If it's not enough, you go to wholesale. If it's not enough, you go interbank before you go to the lender,
the central bank.
Central bank. But but there's just this dark cloud of mistrust in the marketplace, and it's. I'm not sure to what extent the authorities or the monetary authorities appreciate that, because the sense that I got is they seem to actually think that the bankers it is the bankers' fault, because
banks want to make money.
The treasurer
wants to make money.
Would not be doing his work for just closing the day with a positive position, knowing that that those funds are going to be swept away, and in return you get NNCDs. But the point you're raising about the confidence and whether you'll be able to get value from the TBs. If that is the situation obtaining, then the authorities really have to.
It's worse actually in 2025, because we've got 785 million worth of TBs
maturing this year.
Yep. And if that is rolled over, because again, lots of people are relying on that liquidity to actually fund their operations. So there'll be banks that made that decision to buy those TBs, and they were looking forward to that liquidity or part liquidity. And if that part liquidity doesn't come, then they're in a tight spot.
Well, look, I actually look at that and I think of it as a great opportunity, because what that tells us, right? If you look at the very steep discount rates that we've seen for TBs in 2024, and the fact that they are challenges settling on maturity, there are, uncomfortable conversations about rolling over where the holder wasn't looking to roll over. It means we've gotten to that place in terms of the way the government funds its operations that is unsustainable, where we are going to hit a wall. And the way I think about it is, there are two solutions. We're at a fork in the road, right? So, one option is default and collapse, and the other one is restructuring, reform, and a fresh raise. And I believe necessity is the mother of invention. I think that the government, faced with those options, will choose the sensible option, which is to restructure and reform the way it issues TBs and manages them. And actually, if they do that, I think they will not only can they make good on a whole bunch of that amount that's maturing this year, I think that they can actually raise fresh capital.
Okay, there's another bigger problem, and I want Ranga to come in here. So let's look at the bank that's actually up, that's long in Zim dollar and US dollar, and has decided that they're not going to lend to other banks for whatever reason, and let's be generous to them. Why are they not lending to the market? Because, you have two options. You could get NNCDs from the central bank at 0%. But surely there are corporates out there who would require this money. Why are they not lending to the corporates?
Because of the same high risk worries that are in the marketplace. The default risk that you're worried about, bank to bank, could be probably much higher with the corporates. because of because I mean most of them are really facing viability problems, so the cash flows are not coming through. But also the other issue will be how many of them are really looking for ZIG liquidity at this point in time. Yes, there could be, definitely there's demand for US dollar loans, borrowings, and I doubt there are too many banks out there that have got capacity to write US dollar loans, but the ZIG demand is probably not there. So it's we've got a problem in the entire economy as a whole, because if the economy is not performing, remember banks, they get their business from the corporate. So that bank is probably not performing because the corporate is also not performing.
But is it not an opportunity to poach clients from other banks? So I'm not going to give Ranga, but probably Ranga has good customers that I can now poach because I can entice them with all this liquidity that I have. Unless you're saying banks have made a decision that actually the risk is systemic in the entire market, and whatever lending they've done, they're happy with that level of lending.
Chances are, if you are a bank with no liquidity problems, you're already banking the top clients. And in any case, most corporates are mouth-banked, right? So you would have a situation where...
Can you not increase your exposure to those top clients?
You can increase the exposure to those top clients if you think that they'll be
able to pay you back.
Yeah, there's a business case. But already, even your top businesses right now, they are seeing volumes going down, and as a business, you don't want to keep adding exposure to those outfits. So look, it's difficult to get it right in an environment where the entire economy is having challenges.
Well, I wouldn't say the entire economy is having challenges. I would put a final point to what Ranga is saying by pointing out that over the last 18 to 36 months, what we've seen is the formal sector losing market share to the informal sector because of all sorts of government policies that have made life really hard for formal corporates. So the bank is your quintessential formal business, right? It's very heavily regulated and it's interfacing with the formal sector because the informal sector is not banking their cash. They're not interacting with the banks. So if the informal sector as a share of the economy is growing at the expense of the informal sector, it means that the banks, in terms of the pie of corporates that they can lend to, is shrinking all the time. And if you actually read between the lines in terms of, when they talk about strategy, they've moved away from trying to make or grow net interest income, and they are more focused on fees and commissions on transactions because the risk is lower. But still,
But then the market, if I'm looking at it, the market is actually telling if the banks are not willing to lend and there's move from formalization to informalization sectors, money moving that way, it actually tells me that the banks are pessimistic, and banks have a global view of the economy because they know how their customers are performing and how the different sectors are performing.
Of course,
they're not lending just tells me that they're pessimistic about the future.
Yeah, of course, the banks are pessimistic. I think already, for the longest time, I think the last 2 years, the financial sector stability was underpinned by low NPLs, non-performing loans. With what we are seeing right now in the economy, chances are NPLs are actually increasing, because business volumes are shrinking. It means cash flows are also shrinking. It means the capacity for a borrower to service the loan is impaired somewhat. So in that situation, I think banks have seen this move before, and quite a number of them. When you look at the history of our local banking sector in the last 15 years, these episodes of tightening macroeconomic conditions leading to companies failing is something that we've seen before. And I think a clever banker will be engaged into safe banking model, and particularly for the top banks, that are picking cheaper retail money, they really don't have pressure for them to be undertaking some of these risky endeavors.
So the central bank. So gentlemen, the central bank's answer to this problem of high liquidity is to make money out of it, to get NNCDs, give NNCDs and take the liquidity at 0%, and then lend to the banks that the other banks don't want to lend to at 20%.
Because the RBZ is happy to take the TBs as securities, which banks, like you're saying, some banks are not comfortable to.
So maybe walk us through that facility and how it's trying to resolve this problem that we've talked about.
Yeah, so the source of that is like what you have rightly pointed out. Central bank is sweeping excess liquidity from banks on a daily basis, giving them NNCD, and in turn, central bank is returning that liquidity into the market, calling upon banks that have got treasury bills, short-term treasury bills, to access that facility. 20% is the rate. And targeting maybe the productive sector of the economy. The idea is to try and inject some capital into business, because central bank acknowledges that whereas tightening the monetary side is important for stabilizing price and exchange rate, if you do it excessively, you're going to stifle economic growth. So in their thinking, this is a way of liquefying the economy.
Or redistributing the liquidity.
Redistributing the liquidity.
The problem I immediately see is where they're getting...
You have an act for seeing problems.
Well, I think it's very important. It's very important that people recognize the immediate problem is you're exchanging US dollar TBs for ZIG.
Yep.
Right. So if it was in the market, it was going to be US dollar on US dollar. No one was ever going to exchange US dollar for ZIG. But now with this trade facility where the central bank is actually making money, 20%, taking inordinate amount of risk, right? Because they're getting TBs, but immediately they're releasing.
Our TBs risk to the central bank. What are you talking about?
Because government will still not pay.
But central bank is government. It's another way around.
Well, no, I think that's the problem. Those are the quasi-fiscal issues that we've been trying to solve. So we have a serious problem.
I don't think central bank will see TBs as risky, because if they really want to unlock some cash from the TBs, they will.
They print.
They'll always be on the front of the queue.
They will print. Literally, they will print. But the issue, because that's a secondary issue. But the primary issue I wanted to address is where this was US dollar asset. A US dollar asset is being exchanged for a ZIG asset. Mm-hmm. Do you see a problem there?
No, I don't see a problem. Look,
okay.
The way I look at it is...
Why is it you don't see a problem?
So if you... I'm just going to... theoretically, there's no problem, right? Theoretically, we're not printing anymore, and we're going to have a stable exchange rate like we've seen over the last 2 months. So the two are interchangeable. There shouldn't be a problem. But from a pragmatic standpoint, over the last several years, we have been printing. This is our affliction. We are given to printing. So if you extrapolate that historical precedent into the future and you assume that we're going to see printing, then you should never mix the two, because one is stable and sustainable, and then the other one is given to hyperinflation. So...
I think Gresham's law has always been very clear about this. The minute you mix a soft currency with a hard currency, we know what inevitably happens is that central bank eventually will suck up all the US asset that the banks have, and they're going to replace them with ZIG assets that they know is a soft currency and it's going to be inflated away. And the biggest winner in all this is actually Treasury.
But how are they sucking it up? Because in any way, you are giving it up as security. If you repay your loan, you still get your TBs back.
Well, eventually they're going to square it off. So what's going to happen is,
I mean, it's security. It's not like you have.
it's the security you have right now as a bank is useless. We've established, right? Because other banks don't.
No,
want it.
you have.
That's your view. It's not something we have established.
Other banks don't want it.
Okay.
Other banks don't want it.
This guy.
It's not useful to other banks.
Other banks
But the
don't want
Reserve Bank will give you liquidity on the back of TV.
They're
I'm
trying to
saying-
demonstrate that
And
it's
I'm
actually
saying
useful.
if the central bank is getting US TBs and they're exchanging those US TBs with something that they print, what do you think is eventually going to happen? They can't print US dollars. They can't print US dollar TBs. And then they're getting...
the state can print and has been printing US dollar TBs. But not
central
US dollar.
bank. I said central bank.
Okay.
And the central bank is going to get all those US dollar TBs from the market, and they're replacing them with a trade facility that's actually in ZiG, a softer currency. And Gresham's law is very clear about that.
Well, look, you know what? To be fair, I think, again, it's just, if you look at the historical precedent, then you're right. But if you look at what's obtained over the last 2.5 months or so, there hasn't been any printing. The rate hasn't really moved. There's been very tight ZiG liquidity. And the question in everybody's mind is this going to be true in the next 30 days, in the next 90 days, a year from now? But over the last
But
2.5 months...
But Rufaro, do you accept that printing of money or increase in money supply comes in two ways? Bank credit and central bank credit.
Agreed?
So there hasn't been any bank credit, but suddenly there's going to be more bank credit. So money supply will increase.
We mean central bank credit.
Just central bank credit first, and then the banks themselves are going to create credit out of that.
But you have just established that banks are not keen on lending. So how are they going to create credit?
No.
They're not.
Remember, that's how banks will get the liquidity, because there are banks that don't have the liquidity that will quite happily go to central bank and get this liquidity. And also because it's liquidity in a soft currency, there will be many customers who will be keen on that.
Which is good.
We've
as long
already-
as they are productive.
No. We've already established that during our survey, explained that 56% of business people in Zimbabwe say that the best way to make money in 2025 is ZiG US dollar arbitrage.
They're not business people. They're dealers.
But it's clear.
They're dealers.
It's clear. They've said that's and if you're gonna get ZiG at 30%, many people will take it. Are you not gonna take it?
But no, I wouldn't. So I'll tell you why.
Why wouldn't you take it?
So the way I think about it is, it's always on balance of probabilities, right? If we were having this conversation this time last year, I would go in and borrow Butsano, and if I could get 3-to-1 leverage, 5-to-1, 10-to-1, 15-to-1, I'd be very happy. I think that in 2025 there is downside risk. We've seen very tight liquidity conditions obtained for the last 2.5 months. Look, the historical precedent says that we're likely to see printing between now and the end of the year. But I would say, if we were having this conversation this time last year, I'd say the probability of that was less than 5%, that there wouldn't be any printing. This time around, I'd say it's probably closer to 30%. So you're
saying 70%, in your probability, there's 70% that the central bank will not print.
No. There's a 70% probability that we'll see printing again. But
so then why wouldn't you borrow?
But I'm saying, here's the thing, right? Hear me out. I'm saying there's a big difference between 5% and 30%, right? Things with a 30% probability happen all the time.
Okay, let's hear your probability. Would you borrow in ZiG for 270 days? Because the central bank is actually giving ZiG facility for 270 days.
Yes, I will.
Or in US dollars. Which currency would you borrow in?
I'll certainly borrow in ZiG.
That's what the majority of people are saying.
I'll borrow in ZiG because it's a softer currency. Who knows what will happen between...
What kind of leverage would you take? Would you be very bullish? Would you take 3-to-1, 5-to-1, 10-to-1, or you would be more conservative than if you were making the same decision this time last year?
I think I'll be cautiously bullish. Look, I have to acknowledge that central bank has done a good job this far. But my biggest problem is that we're just having a side discussion after a meeting today that, I don't think we can celebrate the ZiG stability because
for 2.5 months, yeah, for sure.
Yeah, because I don't think there's ZiG stability. ZiG is just not there. You can talk of stability. You can't talk of stability for a currency which is almost non-existent. It's not there. Look around for ZiG. You can't get it. So basically what has happened is they've dried down, like ZiG is just not there. The economy probably has moved away. Transactions
it's now US dollar cash.
Yeah, it's moved away closer to almost 90, if not 95% US dollar.
And US dollar cash.
Exactly.
Actually.
So the moment any significant amount of ZiG is injected into the market, I think the reaction will be such a spike in the rate.
That's what the central bank actually wants to do.
Yeah, it's a spike. It's a spike in the rate. And for me, my point is to central bank is just drying the liquidity from the market. It's not the solution to our problems right now. They must be confident. They have to engender confidence in the ZiG. Right now, people are just not confident in transacting ZiG. The moment you get it, you want to convert it.
But my advice to central bank is much simple. Is simpler. I have no problems in them taking TBs. That's what they should do. But they should offer US dollar liquidity. You can't take US dollar TB and then offer ZiG. Give US dollar liquidity. Then the market will be fine. And US dollar liquidity, the central bank does have that liquidity.
I see. So you see the problem with that? You see the problem with that?
Yeah.
So we are talking of a market where maybe TBs trading amongst banks and even corporates is not that smooth. And you want to give the market US dollar liquidity on the back of a TB that has got problems. Most people will not pay.
No,
they'll simply default.
But statutory, the central bank does have US dollar liquidity. They took stat reserves in US dollars.
Yeah, look.
So if somebody is offering the central bank US dollar TBs, they should be happy because they are the central bank. They are the lender of last resort. They should be happy to offer that bank stat reserves that are actually in USD.
But they want to promote the local currency.
And therein our problem. You're promoting hyperinflation.
They want to promote
because you're using US dollars and then offering ZiG liquidity.
I think you love. I don't know whether you love this statistic, which is another thing that came out. So their ZiG deposits on the market is 12 billion ZiG, right? And the ZiG is backed by some reserves. And those reserves converted at official rate, they are amounting to 14 billion ZiG. So this number just shows you that
So it's almost 1-to-1.
It's almost 1-to-1.
It's more than 1-to-1.
It's more than 1-to-1. And as far as the central bank is concerned, the way they look at things, they're saying based on this relationship between reserves and deposit, the rate must be around 22.7. What do you say about that?
Oh, no, that's not how it works.
So theoretically, they're saying if we were to just say all the reserves that we have, we're going to buy all the ZiG that are on the marketplace.
Well, it doesn't quite work out like that because the reserves that we have, it's not backing the ZiG. It's actually a cash cover for imports. So your big worry are your imports. How much reserves do you have, and what's the import requirement? Not what's in the deposits, because not all those deposits actually want to import. But your big worry is if everybody wants to import today, what's the import cover?
Yeah,
and
but not everybody
really
has. I'm missing something there, because I might wish to import a Rolls Royce, but if I don't have the money to import it, then it's just a wish, right? So your ZiG balance is your proxy of potential import demand. So unless I'm missing something.
Yeah, you are. Because the ZiG deposits that are there, we've already established they're banks with huge amounts of ZIG. The central bank is taking that ZIG out of the market. So effectively, they're officially taking that ZIG out of the forex market.
So if what you're saying is correct, then the amount of ZIG that's available to import anything is actually lower than the $12 billion number, right?
No, I'm saying it's actually higher because actually the ZIG that's in the market has been sucked out with these NNCDs. So there's somebody.
No. So okay. You're conflating the deposits with the way the central bank manages liquidity. So if you, as Tinashe, go to your bank today and you deposit 100 ZIG, right? And the bank is long 100 ZIG at the end of today, and the Reserve Bank takes that ZIG away as NNCDs, you still have a demand deposit of $100.
Ah, fantastic. So what happens if I go to a bank that's short of ZIG, but I'm long of ZIG?
If you need to import something, right, the bank needs to make a plan. But you are still entitled to that money is still out there for you to make your import.
Yeah, but practically, what's going to happen? So I go to my bank and I say, do not import. And in my account, there's ZIG. But the bank doesn't have the ZIG.
I think
the overall bank position is short.
I think it's
so
already.
Then they'll have to. Then that's when they'll go to the Reserve Bank with their TBs to get liquidity to import.
I think it's already happening, and but don't forget that the central bank sees
all the
positions on the bank, on any bank's balance sheet. So typically they can actually go looking onto your balance sheet and say, you know what, you want us to accommodate you, but you've got this asset. So create some value. So, for example, you are sitting on a foreign currency, deposit or reserve as a bank. It's up to the central bank. They can actually ask you to liquidate your foreign currency position to cover your ZIG.
And last I checked, as far as US dollar cash, and that's here in notes and coins and offshore, it was around 700 million. And deposits were around 2.7 billion.
Yeah, so those are the bank's positions.
That's
not the Reserve Bank's position.
No, I'm just saying, to answer his direct question, that there's already a gap. So they're not going to have the US dollars. Because he's saying if somebody wants to import and they have the ZIG, then the bank must have the US dollars. And I'm saying actually the banks are in a precarious position where they don't have the US dollars, but they don't have the ZIG. But you know what they did have? Is they had statutory reserves because the central bank increased statutory reserves, which is fine. It's their policy. But you can't increase stat reserves. And then when I'm short and I want liquidity, you say, no, go to your other brother. But you increased my stat reserves. So those stat reserves, that's cash, that's US dollar cash that's sitting with the central bank. And if I have TBs, and I'm short, I should be able to go and get accommodation from the central bank in US dollars. Because remember, I'm the same bank that went to the central bank with cash, not cash, as stat reserves, because they increased my stat reserves. So why shouldn't I get accommodation?
You have to get accommodated first by your fellow bankers. That's how the banking works.
So I think the central bank is actually creating a much bigger problem when they start lending. But hey, what do we know? Not much. We'll see what happens in a year. Next point. What else? Discuss. So
the next point is around foreign currency. So. This whole debate around, we've got shortage of foreign currency, and the official market, the willing buyer, willing seller, is unable to fill the demands. Central bank says, no, that's nonsense, because the pipeline demand, if you compare the pipeline demand for forex and how the market has been operating, there's always recently the central bank is putting say 10 million on in the banking sector, and banks only applying for something like 8-9 million, leaving central bank with some change of $1 million. So as far as they're concerned, they're saying everyone who has got a genuine invoice. Right now, there are no outstanding invoice since September. Everyone who has got a genuine invoice, they are getting the foreign currency from the bank at the official rate.
So I agree partially with the central bank that what they're saying is true, but I think that they have to recognize that a lot of it is artificial. So by artificial, I mean right now you have wheat farmers who haven't been paid their ZIG, right? And those wheat farmers are heavy importers. So, and they need to import chemicals and whatever. And if they were to get their ZIG, they would come onto the auction market. So whatever the central bank is telling us, yes, they're telling us, but they're not telling us the full story.
Yeah,
they're not giving us
who
the
owns the
full
wheat
story.
farmers ZIG? Is it the central bank or Treasury?
No, it is Treasury, right?
So that's not the central bank's problem.
I'm saying they're not giving us a full story.
No, from their perspective.
Yeah,
the
but
full
it's not.
story.
No, it's not the full story. It's not a full story because there's a huge demand of people who, if they were paid, they would definitely be queuing. But right now they're not queuing because they haven't been paid.
No. I hear you.
So if you are anticipating, if you are a central bank, you would say to the market, or if you wanted to allay fears of the market, you would say that we know that there are wheat farmers who haven't been paid, but their usual demand is this, and we've got enough to cover for their demands. That's what you would say. You would say.
So what you're saying is very valid. I'm not being facetious. The point I want to make is that the line that the central bank is drawing is to say, so Treasury's got all these bills that they are not able to fund, right? Because if Treasury was in a position to print ZIG independently, they would just do so and pay the wheat farmers, right? The reason why they are unable to pay the wheat farmers is because the central bank is saying, hey, your account is not funded and we're not creating new ZIG to pay these. So you and the wheat farmers need to sit down and figure it out. So in as much as that's a problem from the wheat farmers' perspective, and there is this bill that's real that has to be paid, what it tells me is, from a central bank perspective, is that there's this discipline to say they're not just, when somebody knocks on their door and says, hey, there's this unpaid bill, but we don't have the funding yet, please just make it available. They actually have the discipline to say, no, we can't just print.
So if I'm central bank, I wouldn't be as arrogant. Because constitutionally, if I'm Treasury, you're supposed to print up to 20% of last year's revenues. So they may have been that arrogant last year, because last year maybe the Treasury had borrowed up to their limit. But come January, whether you're central bank, whether you like it or not, if I say you must print, constitutionally you must.
No, so it doesn't actually quite work like that. So what from a funding perspective, what the Constitution says is that the state Treasury can borrow up to 20% of its revenue, right?
Yeah.
It doesn't say that it can pick up the phone and call central bank and say, give us 20% of last year's revenue. They have borrowing authority, just like a corporate can have borrowing authority, right? But they can walk to their bankers, and the bankers will be like, yeah, your memo say you can borrow X amount, but we're not giving you a penny.
Based on us.
Because we don't like your risk profile, we don't like, they're your banker, right?
No.
If you think about
the minute the bank has given you a facility, the bank has said, we're giving you an overdraft facility.
But Treasury does not have a constitutional facility.
No, but
this is the point that I'm trying to make.
No, but even for a bank, a private bank, they can give you a facility, but you go there for a drawdown. They say, no, we don't have the liquidity at the moment. Maybe come back next week or whatever.
Or next month.
Yeah, but eventually
it's normal.
But you can't say no. Eventually you will.
But that is effectively
It's
saying
a no.
No,
It's a no. Because it means you are not able to get it when you want it.
But constitutionally, you see, the only thing that central bank could do is to say constitutionally I can't give you more than. So that's being a relatively better governor than the previous governors, because the previous governors didn't care about the constitution. So that's the only way in which the current governor could say, well, I can't give you because...
No, but I think you're reading...
Right? And I'm just saying that this year...
is wrong of the constitution.
No, it's actually correct.
Well, what it says is that the Treasury cannot borrow more than 20% of the previous year's revenue. It does not say that if it's within the 20%, it can just order central bank to release cash. They don't have that authority. it's always been implicit that if they ask, the central bank won't say no. It's always been implicit, but it's not de jure. It's not. They don't have a legal right to get.
No, they have a legal right. What you're saying is a central bank can push back.
No, the central bank can say no.
No, constitutionally they can't say no.
They're a banker. No. They're a banker. They can say no.
No. Okay. From a constitution, right. Okay, if this thing, okay, Ranga, you're the lawyer. If this thing goes to Supreme Court, and Treasury says,
let's leave the lawyer. You're the lawyer bit. But
if we go, so let's suppose.
But let's ask the bankers. Let's get some feedback from the audience. We can. We're in danger of going down a rabbit hole here. But I have high conviction that I'm right on this.
Okay, from a law.
So there's a constitutional provision that say you can borrow up to.
Yes.
But it's borrowing.
Yes.
So it's not like you can force
a bank to give you money.
In as much as you are the shareholder of this bank, if there is maybe a sheriff running this bank for you, so the central bank governor, he has got some leeway even to time the borrowings.
Timing, I perfectly understand.
He can also say no.
Even to push back and say no. What do you want to borrow for? Have you tried to do 1, 2, 3? You know, I don't know. It wasn't official.
Gentlemen, it's the benevolence, pure benevolence of Ministry of Finance or Treasury to not push hard on the 20%. Because if you push hard on the 20%, the only thing is you can go to His Excellence and say, well, this is what the Constitution says, and then His Excellence might say, but you're misusing the money.
Exactly. So central bank can also go to.
But okay, let me ask you a different question, Tinashe, because I think much of this discussion is academic because of where the Treasury is right now. Do you think, in terms of the outstanding TBs, outstanding government of Zimbabwe borrowings, it's less or more than 20% of last year's revenue?
Yeah.
Already, like right now as we speak.
Oh no! Yeah, it's far less. Right now they're starting on zero. When you start the year, you start on zero, and that's why they push them to TBs, because once you push it on TBs, it's now longer term dated paper. So it's more than 1 year. It's not included in an overdraft facility. It's not central bank facility. That's why I said I can see why the governor was a little bit arrogant last year, because he could actually push back from a constitutional perspective. So you could say, well, you guys want money, but you've exhausted your overdraft. Just like your bank. Your bank would say, but you've exhausted your overdraft. Tozo Nanashi, next year. That was the only way you could push back. And I admit and I agree that you could also push back from a timing perspective. You could say, oh yeah, you want this much, but unfortunately, when I look at my yield curve, when I do this, when I do my numbers, can we push it further down the road? But he can't say outright no and say no for the entirety of the year. He cannot.
Okay, that remains to be seen. Let's put that to the audience and see what kind of feedback we get. With some people doing their homework on exactly what the Constitution says about government borrowing and what it can and can't make the Reserve Bank do.
But do you think I've done a bit of research on this. Zimbabwe is the only country in the world that has that constitutional provision. So in America, you can't.
Well, the Fed is privately owned, so...
Well, no, even if it wasn't, and everywhere around the world, what typically happens is the government has to come into the open market and say, we would like liquidity. And it's the central bank can make its own decision, whether it's independent or otherwise, to buy those TBs or not. But they do so in the open market. You don't have an outright overdraft facility. That's the difference between Zimbabwe and the rest of the world. And actually, that's part of the reason why Zimbabwe has always suffered from hyperinflation. It's because of that provision. And I know the governor might push back and say, I can stop them. But I would say if the governor is interested, all he just needs to do is to have a constitutional change where we say the government no longer has an overdraft facility. And if the government wants to get money from the market, they must come into the open market, and the central bank must make its own decision whether to fund or not. So let's suppose right now, if Treasury wanted to come onto the market and raise money, and the banks are not giving government money, then the central bank will then say, well, okay, we will give you our money. and they will do so on the open market. And then you then need to look at the yield curve and get into the negotiations that you guys are actually talking about, where it becomes purely commercial. And the central bank can actually push back, can say, no. You guys want 5 billion, but we think that, what you messed up last year, and this is what you did, but we understand that the market needs liquidity, and we understand that you need to fund, and we're looking at how much money you're going to collect in terms of revenue over the next 10 years. We're quite happy to take the longer dated paper because the market doesn't want longer dated paper. So as central bank, we will take your 10-year TBs and we will give you the liquidity, and we will print. So in America, that's what they would do, that they will literally print, but it's in the open market, and it's really looking at the yield curve. In Zimbabwe, overdraft facility.
I'm not sure if it has always been like that. I will benefit from the input of senior bankers, but I think that provision was there as a buffer. The open market operations have always been very vibrant. You were talking of discount houses, so that era of discount houses, finance houses, before we got into this 2007, 2008 hyperinflation, the open market operations were quite vibrant. Look, I'm not saying this on fact, but at that time, the issue of central bank overdraft was not
any issue.
It was not any issue.
So it was good character. I agree. Right?
Yeah, it was just there, just as a buffer.
No, it was there as a war provision.
Exactly. As a war provision.
It's a war provision.
Okay, so if you're in a crisis mode and you can't access liquidity from all your typical.
And you're the lawyer. Okay, I'm not going to say that, but even as a country, I think these are things that we need to discuss. That when you're making laws, there's making laws believing that you have good actors, and there's making laws saying what happens when you have bad actors. So I think that the initial provision, and many countries had it previously, and it was really targeted around the world, because remember, we were on the gold standard, so you couldn't print, right? But during a war, and you needed to print as quickly as possible, the only way you could do so was to have this constitutional provision of an overdraft. So many countries had that, and it was in case of emergencies. But it was a law that was assuming good actors.
That you're not breaking the glass every day.
Exactly. But the minute you have bad actors, they can go beyond the 20%.
So I guess maybe that's the difference that the new governor can possibly make, where they say, no, the provision is there, but it doesn't mean you must always come looking for a central bank overdraft. And I think it's possible for him to make a case to His Excellency and say, if we allow this facility to be abused, then we're going to have liquidity. Hyperinflation again, and the exchange rate is going to go through the roof. Is that what you want? Chances are he will side with the central bank on that.
Something that I would actually support the governor, and I will do all his public relations effort if he comes out and he says, let's make a constitutional change. So remember what I'm saying, that, okay, he might be in a good relationship with His Excellency, and he might use that to his advantage. But we must say, what happens if he's not there? So if he wants to make the biggest drastic change in Zimbabwe, he should come up with a bill, come up with an act of parliament, or constitutionally, because actually the central bank, I think it's chapter 13 where they create the central bank. There are many loopholes. If he can get that constitutional provision where it clearly states that government cannot borrow, does not have an overdraft facility from the central bank, I think that half of our problems will be gone.
Can you lobby for that? I mean, we are
that's exactly what I'm
doing. I'm lobbying for that,
okay.
And I'm saying if the governor is hearing this is something that I am willing to support him wholeheartedly on, to get a constitutional amendment or an act of parliament that says Treasury has no facility with the central bank. They should come onto the market if they want to borrow, and the central bank, in its own discretion, can decide to print for government, but it must be open. It must not be something that happens behind the scenes where you have this overdraft facility. Because right now, I'm telling you, it's the benevolence of Treasury. Because if Treasury really push hard, he has no say except to run to HE. I admit, he can just run to HE and say,
Batanga.
But he doesn't have the constitution behind him. And if I were him, I would say when you look at the 2013 constitution, it gave the powers to Parliament to then enact a new Reserve Bank Act. And I think that this is a good time for us to do so. And I think it will be a great legacy issue for the current central bank if you were to act on it. So anyway, gentlemen, I think
maybe let me just shout out if you're about to wrap up.
Yeah. Go ahead.
So we just want to thank everyone who is watching the show live with quite a number of viewers. So there are some comments or just some positive feedback that we're getting from some of our viewers. There's Hillview BNB. We're saying thank you, gents. The show is getting better and better. Thank you so much. We love the fact that you are loving the show. And then Kudzai Masora, where can I get the Friday Drinks golf t-shirts and caps? We can have a chat. We are actually creating more of these golf shirts and caps. The caps actually look quite nice. I know someone was saying this and
someone was whinging.
Yeah, I can't be wearing a cap indoors. But it's looking dapper. I don't know what you guys think. Look at Mkanya here. It's looking dapper in the cap.
I'm not really sure, but I was forced to by the producer. So
so we have got these t-shirts, these golf shirts and caps. So thank you so much. We appreciate. Maybe our target is to get to 10,000 by, let's give ourselves maybe 2 months.
Yeah, Q1.
Yeah, by end of Q1. So help us, guys, to get to 10,000 subscribers and make your show
widely
available.
Thank you very much. Gents, I think let's have fun. It's Friday.
Yeah, we will, for sure.
Cheers.
Cheers.